Hey everyone, welcome back to Corporate Decoder, where we dive deep into the nitty-gritty of company finances, and guess what, we've got another bank's quarterly report to dissect. And it's packed with big numbers and strategic moves to help you understand where this bank is really heading. So let's get straight into Mercantile Bank Corporation's latest report. Stick around to see if they're sailing smoothly or hitting some choppy waters. And hey, if you love getting clear, no-nonsense breakdowns of financial reports like this, make sure you hit subscribe and join our Discord community linked in the description below. Alright, kicked off with the basics. This filling covers their performance up to June 30th, 2025. They're reporting a net income of roughly $42.2 million, up from $40.3 million in the first half of 2024. This growth mostly came from earning more interest on their loans, paying less in taxes, and need to set aside less money for potential loan losses. Now let's talk about their core business lending. Their total loans grew by about $97 million in the first 6 months of 2025, which is a decent 2.1% increase. The big story here seems to be in their commercial loans, which saw a jump of about $114 million. Commercial and industrial loans, which are loans to businesses for things like equipment or inventory, increased by $88 million. They also saw growth in loans for multifamily and residential rental properties, up by about $43 million. This growth in commercial lending is great, but they are anticipating some larger commercial real estate loans to be paid off later this year, which might slow things down a bit. Identity inventory increased by $88 million. They also saw growth in loans for multifamily and residential rental properties, up by about $43 million. This growth in commercial lending is great, but they are anticipating some larger commercial real estate loans to be paid off later this year, which might slow things down a bit. On the residential side, things are a bit different. Their 1 to 4 family mortgages, which are your typical home loans, actually decreased by about $28 million. This is because more people paid off their mortgages or made scheduled payments than new loans were taken out. They originated almost $242 million in residential mortgages in the first half of the year, but most of those were intended to be sold off, not kept in their own portfolio. When we look at how well their loans are doing, the overall picture looks pretty healthy right now. Non-performing loans, those that are significantly behind on payments, were about 0.21% of their total loans at the end of June. That's a really low number. They actually had no foreclosed properties on their books, which is always a good sign. Plus, gross loan charge-offs, meaning the amount of loans they had to write off as uncollectible, were only about $100,000 for the first 6 months of the year. They even had a small net recovery on loans, which is quite positive. The company also reported their allowance for credit losses. This is the money they set aside to cover loans that might go bad. It stood at about $58.4 million, which is around 1.24% of their total loans, while they had some increased provisions for credit losses this period, mainly due to a construction loan that became non-accrual and overall loan growth. The overall quality of their loan book seems to be keeping these numbers in check. Let's switch gears to their investments. Securities available for sale, which they mark to market value, increased by about $96 million to a total of $826 million. They've been buying more US government agency bonds and municipal bonds. Now, here's an interesting detail. They had a net unrealized loss of about $45.3 million on these securities. This might sound bad, but it's mostly due to changes in interest rates, and they believe the value will recover. They are keeping these investments at a level that provides good liquidity and helps manage their interest rate risk. Now, looking at where they get their money, total depositants increased a modest $12.1 million in the first 6 months of 2025. Non-interest-bearing checking accounts, which are checking accounts that don't earn interest-bearing checking accounts like money market accounts and time deposits, saw growth. They also had a significant increase, about $21 million in sweep accounts, which are basically overnight investments for their customers. They also borrow money from the Federal Home Loan Bank. These advances decreased by about $31 million in the first 6 months of the year. These are generally used to fund loan growth and manage interest rate risk. The core of a bank's profit is its net interest income, the difference between what it earns on assets and pays on liabilities. This increased by about $2.4 million in the second quarter and $3.6 million in the first 6 months compared to last year. However, their net interest margin, which is basically their profit margin on interest, did shrink a bit. This is because while their loan yields went down due to lower interest rates, their cost of funds also decreased, but not quite enough to keep the margin as high as before. Moving to income that isn't from interest, things like fees from services, this category saw an increase of about $1.8 million in the second quarter compared to last year, mostly from mortgage banking, interest rate swap fees, and treasury management services. For the first 6 months of the year, this income was relatively stable. On the expense side, non-interest expenses went up by about $3.7 million in the second quarter and nearly $5 million in the first 6 months. A big chunk of this increase is due to higher salaries and benefits for their employees, and also increased costs for data processing, likely related to technology and software. Their federal income tax expense went down significantly. For the second quarter, it dropped from $4.7 million to $3.3 million, and for the first 6 months, it fell from $10.2 million to $7.9 million. A big reason for this drop was the acquisition of transferable energy tax credits, which provided a nice boost to their tax savings. Looking at the balance sheet, their total assets grew by about $129 million in the first half of 2025, reaching over $6.18 billion. This growth was driven by loans and securities. Their net premises and equipment, basically their buildings and office gear, increased slightly with depreciation and new investments contributing to the overall value. PF2 on July 22, 2025, we entered into a definitive merger agreement with Eastern Michigan Financial Corporation at FEN AUPS, a deal to acquire Eastern Michigan Financial Corporation at about $95.8 million, a mix of cash and Mercantile stock. This acquisition signifies a big growth stride for Mercantile, expanding their reach and market presence. There are always risks with mergers though, like integration challenges and regulatory approvals, but they seem confident this will be a positive move for their future. Maximum number of shares or approximate dollar value that may yet be purchased under the plans or programs, CORPs. Also worth noting, they authorized the stock repurchase program back in 2021, and as of June 30th of 2025, they still had about $6.8 million worth of shares they could buy back. However, they didn't actually repurchase any shares in the first 6 months of 2025, which suggests they're prioritizing other areas for capital allocation right now, like loan growth and preparing for the upcoming acquisition. PF this makes Mercantile Bank Corporation look like a pretty solid growing institution. On the positive side, their loan quality is excellent with very low non-performing loans and minimal charge-offs. Their net income is up and they're actively growing their commercial loan portfolio. Acquisitions like the one with Eastern Michigan Financial Corporation show ambition and a clear strategy for expansion. However, there are always things to watch. The slight dip in their net interest margin, while still healthy, is something to monitor, especially with any further shifts in interest rates. Rising non-interest expenses, particularly in salaries and technology, need to be managed carefully to ensure they don't eat too much into profits. And like any merger, the integration of Eastern Michigan Financial Corporation will be a crucial test of their management's execution. Overall, Mercantile Bank Corporation seems to be navigating the current financial landscape quite well, showing resilience and a strategic focus on growth. They're hitting their stride with strong core banking operations and ambitious expansion plans. Alright, that's a deep dive into Mercantile Bank Corporation's latest financial report. What do you think about their growth strategies and the upcoming acquisition? Let me know your thoughts in the comments below. If you found this breakdown helpful, give it a thumbs up, subscribe for more corporate insights, and join our Discord community. Thanks for tuning in to Corporate Decoder. See you next time.